good day to everyone. ICI has now released a statutory update for January 2025 CA Intermediate Examination, and this is a statutory update for income tax law. And in this video, we are going to discuss the statutory updates for income tax law to the extent these are relevant for TaxBook Plus. Not all the updates in this document, but only those which need to be, made a note of as far as TaxBook Plus is concerned. If you look at this ICI statutory update document, it's a long document, 36 pages, and there is a long list of updates. And the reason is that the ICI study material was updated only till 30th April 2023, and therefore from 1st May 2023 to 30th June 2024, all these updates become relevant for January 25 examinations. But in the TaxBook Plus, only two updates, this one and this one, is relevant. So all other updates are already incorporated in the TaxBook Plus, so we need not worry about that. But before we move on to discuss these two updates, I just want you to understand one point regarding section 43B. So if you look at section 43B, this is para 118 of TaxBook Plus. One of the sums payable which was incorporated by Finance Act 23 is any sum payable to a micro or a small enterprise beyond the time limit specified under section 15 of MSMED Act, right? What is micro or small enterprise is given here. So there is a classification which is separate for manufacturing or enterprises or enterprises engaged in production of goods and enterprises engaged in rendering of services. So there is an update here, and instead of this particular table, you need to note this table, and this classification is now common for manufacturing as well as service enterprises, and it depends on investment in plant and machinery or equipment and the level of turnover. So if the investment in P&M or equipment is not more than 1 crore and, okay, cumulative condition, turnover is not more than 5 crore, then classification will be micro enterprise. But if the investment in P&M or equipment is not more than 10 crore and turnover is not more than 50 crore, then the classification will be that of small enterprise. So you need not strictly remember this, because in the exam you will not be given these figures and asked to further classify the enterprise whether micro or small and then proceed to apply section 43B. Rather, in the question itself, it's very likely that you will be given the classification. You will be told whether the enterprise is micro or small or medium as the case may be, and then you will be asked to apply section 43B. So just keep this in mind. This is for your knowledge and reference. Now we move to this statutory update document, and we move first to guidelines under section 1010D of the IT Act. Okay, so this is a circular which was issued by the CBDT, and we are not going to cover all the items which are there in the circular, because many of them find place in TaxBook Plus. What we are going to cover are those things which do not find place in TaxBook Plus. So CBDT has given lots of examples on application of the recent amendment made by Finance Act 2023 in section 1010D, that means exemption in respect of LIP. But before we move to that, we'll just take a quick look at the life insurance policy taxation under section 1010D, and this is page 70 of TaxBook Plus. So key man insurance policy, as we know, is taxable in all the cases. Excess premium policy is exempt if received on death of a person, else it is taxable. And as far as any other policy is concerned, it continues to be exempt in all the cases. Now, regarding excess premium policy, what is excess premium policy? When one or more of conditions 1 and 2, so either condition 1 or 2 or both are satisfied, then the policy becomes an excess premium policy. And in such case, exemption is not available under 1010D. The maturity proceeds become taxable. So condition 1 is what? Premium payable for any of the policy years exceeds a prescribed percentage of what? Sum assured. And this is the prescribed percentage, 20% or 10% or 15%, and this depends basically on the date of issue of policy. Okay. And what is condition 2? Policy is issued on or after 1st April 2023 and the premium payable for any of the policy years is more than 5 lakh. In such case also the policy becomes an excess premium policy. Now we look at the illustrations which have been provided in this circular. So this is example 1. Life insurance policy, date of issue is 1st April 2013, annual premium is 6 lakh, sum assured is 60 lakh, and consideration received on maturity 70 lakh. Now, okay, so one point that I want to tell you is in all the examples. So this circular is basically to explain the application of this condition 2, okay, not condition 1. So condition 1 is so the examples are set in such a way that condition 1 is not satisfied in any of them. For example, if you look at this, so 1st April 2013, so the benchmark percentage is what? The benchmark percentage is what? 1st April 2013. So date of issue, and the premium for any of the policy years should not be more than 10% of the sum assured. And this is what is the position in all the examples. So 6 lakh of 60 lakh is basically exactly 10%. So it's not more than 10%. And this is the way how all the examples in the circular have been drafted. So what is, so basically this particular condition is not getting satisfied. Okay. This condition 1 is not getting satisfied in all the examples. So in all the examples, what we need to simply check is whether condition 2 is getting satisfied or not. If yes, then the policy will become an excess premium policy and exemption under 1010D will not apply. Okay. So here the date of issue is 1st April 2013, which is before 1st April 2023. So condition 2 is not applicable, right? And condition 1 is also not satisfied as we saw. So therefore the policy is not an excess premium policy and 1010D exemption will be available. Okay. Example 2. So date of issue is 1st April 23. Okay. Now this policy is issued on or after 1st April 2023. So condition 2 starts becoming applicable and we need to check this now. So 1st April 23, annual premium is 5 lakh, sum assured is 50 lakh, consideration on maturity is 52 lakh. Now 5 lakh is not more than 10% of 50 lakh, so condition 1 is not satisfied, but 5 lakh is also not more than 5 lakh, it's exactly 5 lakh, so condition 2 is also not satisfied. So the policy is not an excess premium policy and therefore 1010D exemption is applicable. It will apply, it will be available. Example 3. Date of issue once again is 1st April 23. Here annual premium is 6 lakh and sum assured is 60 lakh. Consideration on maturity is 70 lakh. So 6 lakh is not more than 10% of 60 lakh, but 6 lakh is more than 5 lakh. So condition 2 gets satisfied. So the policy becomes an excess premium policy and 1010D exemption will not apply. Consideration received on maturity will become taxable. Taxable under which head? We know, under income from other sources, IFRS. Example 4. Now here there are two policies. So this is a case of what? This is a case of multiple policies. This is a case of multiple policies. Okay. So in case of multiple policies, we know what is the position in respect of this condition 2. If there are more than one policies, then what will be the position? So multiple policies referred in condition 2 above. If the premium is payable for more than one policy issued on or after 1st April 23, okay, exemption under 1010D is applicable only with respect to which policies? In respect to those policies where the aggregate amount of premium doesn't exceed rupees 5 lakh in any of the policy years. So in any of the policy years, we need to check whether the aggregate amount for multiple policies exceeds 5 lakh. If yes, then exemption will not apply. So here there are two policies, A and B, and both are issued on 1st April 23. Annual premium in both the cases is not more than 10% of sum assured. And if you look at the aggregate comes to 3 plus 2, 5 lakhs. So 5 lakh is the aggregate premium, which is not exceeding the threshold of 5 lakh. So condition 2 is also not getting satisfied, and hence A and B both are not excess premium policies, and therefore consideration received on both the policies will be exempt under 1010D. Clear? Now we look at example 5. Policies A and B both are issued on 1st April 23. In both the cases, the annual premium is not more than 10% of sum assured, so condition 1 is not satisfied. Now what about condition 2? If you take the aggregate of both, it comes to more than 5 lakh. Okay, so both will not be exempt under 1010D because the aggregate is coming to more than 5 lakh. B by itself will also not be exempt because 5 lakh 50,000 is more than 5 lakh. A will be exempt under 1010D because for A itself the premium is not more than 5 lakh. So the result will be that policy A will become exempt under 1010D, whereby policy B will be taxable. It will not be exempt under 1010D. Clear? This is how you need to assess the questions when they are given in the exams. Now here we have 3 policies, A, B and C. Both are issued on 1st April 2023. In both the cases, annual premium is not more than 10% of sum assured, so condition 1 is not satisfied. What about condition 2? Well, now we need to check the aggregate. The aggregate of A, B and C comes to more than 5 lakhs, so all will not be exempt. C by itself will not be exempt also because the premium of 6 lakh is more than 5 lakh. What is left is A and B. So if you aggregate A and B's premium, 1 lakh plus 3 lakh 50, it comes to 4 lakh 50, which is not more than 5 lakh. So that this means that A and B will be exempt under 1010D, but policy C will not be exempt. Proceeds will be taxable in the case of policy C. Okay. Now we come to example 7. Now here we have 4 policies, X, A, B and C. A, B and C are issued on 1st April 23, but X is before 1st April 23. It's the date of issue is 1st April 22. Annual premium in all the 4 cases doesn't exceed 10% of sum assured, so condition 1 is not satisfied in all the 4 cases, and this is the consideration received in the case of all these 4 policies. Now since X, in the case of X, condition 1 is not satisfied, as we saw. Condition 2 is also not satisfied because the date of issue is before 1st April 23. So exemption under 1010D will apply. Okay, so policy X will be exempt under 1010D. Now what is left is A, B and C. Now when we talk about A, B and C, for these policies A, B, C, we need to check the aggregate threshold of 5 lakh. We should not check the aggregate threshold of 5 lakh by including policy X because the date of issue is not on or after 1st April 23. So X is not getting covered under condition 2 in the first place. So A, B and C. C by, okay, the aggregate of A, B and C is more than 5 lakh, so all the policies will not be exempt. C by itself will not be exempt because the premium is more than 5 lakh. But A and B aggregate is 4 lakh 50,000, which is not more than 5 lakhs. So A and B will become exempt. C will not be exempt. So in the result, X, A and B will be exempt under 1010D, whereby exemption will not apply to policy C. Okay. Example 8. Once again, we have X, A, B, C, 4 policies. Now, 1st April 2024 is the date of issue for ABC and 1st April 23 for X, but all the 4 policies are issued on or after 1st April 2023. So we need to check condition 2 as well. What about condition 1? As in all the examples in the circular, condition 1 is not getting satisfied because the annual premium is not more than 10% of sum assured in all the cases. Okay. Now, if we assume that so X will mature first and ABC will mature later. Now we can assume that X matures first and therefore the SSE has claimed exemption under section 1010D in respect of X. Why? Because condition 1, as we saw, is not satisfied, and condition 2 is also not satisfied because 4,50,000 is not more than 5 lakhs, so SSE can claim exemption under 1010D for policy X, and we assume that the SSE did so. Okay. Now what is left is next year when ABC also get matured, then we need to figure out which of the policies out of ABC will be exempt under 1020. So if you look at XABC, 4,50,000 out of 5 lakh has been exhausted, because except for 1 year, except for the years which are not common to X, A, B and C, all other years, in all other years, the premium payable for X, A, B, C together aggregate is more than 5 lakh. Okay, and we need to check whether in case of multiple policies issued on or after 1st April 2023, which is the case in all the policies here, the aggregate premium payable in any of the policy years is more than 5 lakh or not. Okay, so 4,50,000 we have already exhausted. What is left is 50,000. So if we take X and A as exempt, it will not be possible, because 4,50,000 plus 1 lakh is more than 5 lakh, X plus B also and X plus C also. So the result will be that none of A, B, C will be exempt, whereby only policy X will be exempt under section 1020, right? So basically, when there are multiple policies, you need to figure out if for any of the policy years, that means the common policy years, the aggregate is coming to more than 5 lakh or not, right? Now we come to example 9. Here also we have XABC, and 1st April 2023 date of issue for X, and 1 year later for A, B and C, and therefore the maturity for X is 1 year before A, B and C. So here again we are taking an assumption that the SSE claims 1020 exemption first for X, because X is maturing first. Now in the question it will be clear, okay, that whether for the policies maturing first, how is the SSE planning to claim the exemption. If the question is silent, then we will need to make necessary assumptions and we will have to solve the question. So for example, if nothing is given in the question except what is given here, then we can write in the question that assuming that SSE claims exemption under policy for policy X first because it is maturing first, and because condition 1 is not getting satisfied and condition 2 is also not getting satisfied for X, because 2,50,000 is not more than 5 lakh, then what will be left is to decide which of the policies out of A, B and C can be claimed as exempt. So 5 lakh out of 5 lakh, 2,50,000 has been exhausted, and there are common policy years, and for any of those years we need to check for X, A, B and C whether the premium is more than 5 lakh or not, and only those policies where the aggregate doesn't exceed 5 lakh will be exempt. So what is left is basically 2,50,000, okay, the balance which is left. And policy C is a straight away out of question because it's 6 lakh. So it's more than the balance of 2,50,000, so it will not be exempt, it will be taxable. X and A will be 4,50,000 and X and B will be 5 lakh. X, A, B, X, A and B, all three cannot be claimed exempt. So we have a choice here. So either X and A or X or B. In both the cases, exemption can be claimed. So SSE needs to make a choice between A and B. Make a choice between A and B. So how will you make a choice? If you apply your logic and common sense, see all the policies which are taxable will be taxable under the head IFOS. So you should compute the amount which will become taxable under the head IFOS. Okay. So out of A and B, the amount taxable under IFOS which is greater should be claimed as exempt. An amount which is taxable under IFOS which is lesser out of A and B should be claimed as taxable. That's the way the overall tax incidence will go down. So for this, you already would have studied para 177A.3, taxation under IFOS in the case of excess premium policy. And how do we determine the income taxable? It's sum or the aggregate of sum received under the policy, okay, minus the aggregate of premiums paid during the term of the policy. which has not been claimed as deduction under any provision of the Act. So basically, in our example, what we need to figure out is the sum received under the policy, that means the consideration on maturity, and we need to reduce the aggregate of the premium paid. Okay, this will give us the income taxable under IFOS. So if we look at A, okay, if we look at A, what is the policy paying term? So from 1st of 23 to 2033, basically 10 years. 10 years is the annual premium paying term. Okay, so for A, consideration received is 24 lakh minus the premium that would be paid is 2 lakh into 10, that means 20 lakh. So 4 lakh. 4 lakh will be the amount taxable under IFOS. And for policy B, it will be 38 lakh minus 2 lakh 50 into 10, that means 25 lakh, which means 13 lakh. So income which is taxable under IFOS will be more in the case of B, so it will be advisable to claim policy B as exempt and policy A as taxable. So in the result, A and C will become taxable and X and B will become exempt under 1010D. This is how you need to solve. Okay, so if there is a choice which is available, then you need to make computation of taxable amount under the head IFOS and then compare, and in whichever combination the amount taxable is greater, that is what you should claim as exempt under 1010D. Okay, now there is an alternative treatment here. Alternative treatment is that, now let's assume now that the SSC does not claim exemption for policy X. Even though it matures first, SSC says that, okay, I will pay tax on it. Okay. Now what will be left is policy A, B and C. And we will have to figure out what are the policies in which exemption can be claimed. C is out because by itself 6 lakh is more than 5 lakh. So in this case, A and B combined premium becomes 4,50,000. So both A and B can be claimed as exempt. So if in this assumption that X is not being claimed as exempt, so the result will be that X will be taxable, C will be taxable, and A and B will be exempt. Okay. Here we need not make computation under IFOS because there is no question of a choice, because A and B are only the options left and the combined premium is not more than 5 lakhs. So straight away we can say that A and B will be claimed as exempt. Okay. Example 10. Now here we have 5 policies X, Y, A, B and C. And all of these are issued on or after 1st April 23. X and Y are 1st April 23 and 1 year later A, B and C are issued. And condition 1 is not satisfied because in all the cases annual premium is not more than 10% of sum assured. So now for X, while X and Y are issued in the same year, but the term for X is the term for X and Y is 11 years basically. 1st April 2023 to 1st November 2034. But 1 year before Y, policy X has been surrendered. So this amount has been received on surrender. Okay. So 1 year before Y, consideration has been received on surrender of policy X. On maturity, then we receive the consideration for Y, and 2035, 1 year later, we receive consideration for A, B and C. Okay. Now here, if you look at the position, so 2 lakh, 2 lakh, 2 lakh, 3 lakh, 3 lakh. So all of these policies will obviously not be exempt. And now here also, since it's not specifically given in the example, we need to make the assumption. So first assumption is that we claim exemption under 1010D in respect of X and Y first, because these are the policies. So X is what we received, the consideration we receive first and foremost, and annual premium is 2 lakh, which is not more than 5 lakh. So we straight away claim this as exempt. Now next, in the next year we receive consideration on Y and Y also. If we aggregate X and Y, 4 lakh is not still more than 5 lakh, and therefore we also claim exemption under Y. So X and Y we claim exemption. Now comes the turn when we receive proceeds from A, B, and C. So 4 lakh has already been exhausted out of 5 lakhs, so remaining is only 1 lakh, and all these policies the premium is more than 1 lakh, so in none of the cases exemption can be claimed. So A, B, and C will become taxable, and X and Y will become exempt. Okay, so here we are assuming that as the consideration is received by the SSC, the SSC tries to claim exemption under 1010D to the best extent possible. Now here also we have an alternative treatment. We change the assumption. Now here the assumption has been changed. What if the consideration on X is not claimed to be exempt? Then what will be the position? Say if X, the SSC says, okay, I will not claim it as exempt, I will pay tax. Then next year, the question comes whether what to do for policy Y. Okay, so Y, of course, premium of 2 lakh is not more than 5 lakh, so Y can be claimed as exempt. So in this case, X is what we claim as taxable and Y is what we claim as exempt. Now next year we get proceeds from A, B, and C, and now we need to check. So out of 5 lakh, 2 lakh has already been exhausted, so the balance is 3 lakh. The balance is 3 lakh, so either of A or B can be claimed as exempt. See, it is not necessary that the premium for B is more, so therefore please we can claim it will be good or better to claim B as exempt. No, we should, if there is a choice, and we should compute the estimated taxable income under the head IFOS. So we do this for A and B now because we have a choice of whether to claim exemption for A or B. C, of course, we cannot claim because the premium of 6 lakh becomes more than 5 lakh. Now, see, consideration for A is 24 lakh and 2035. So basically, it appears that the premium term is 11 years. So 2 lakh and 3 lakh, 22 lakh and 33 lakh. So 22 lakh and 33 lakh. So this will come to 2 lakh and this will come to 3 lakh. So taxable amount under IFOS will be more for policy B, so it makes sense to claim exemption for policy B. And consequently we don't claim exemption for A and C. So in the result, Y and B will be exempt while the other policies will be taxable. Okay. So these were the illustrations or the examples, and this is how you need to approach them when you get such kind of questions in the exam. Now we come to the other 2 points which are given in the circular: clarification on GST component. Now GST is applicable on the premium. Okay, so it is clarified that the premium payable or the aggregate premium payable for a policy is issued on or after 1st April 2023 for any previous year would be exclusive of the amount of GST payable on such premium. So GST you should not include in the amount of premium when you are checking the threshold of 5 lakh. So for example, if the premium, if say the sum assured is 50 lakh and the premium is 5 lakh, okay, and you add GST component, say you add GST at the rate of 4.5% or whatever be the rate in force. So the premium after adding GST will become more than 5 lakh, and therefore you will say that the premium is becoming more than 5 lakh and therefore it becomes an excess premium policy. But no, what the CBDT is saying, you should not include the GST payable amount. So GST you will not include, you will just ignore GST. So 5 lakh will not be more than 5 lakh, so the exemption can be claimed under 1010D. So GST component is not to be included in the amount of premium. Okay, this is the point that has been clarified. Now the next clarification is on premium on term life insurance policy. Now what is a term life insurance policy? Term life insurance policy is a policy which is effective for a particular term. Okay, so for example, the policy is for a term of say 10 years, and for all these years the SSE will pay the premium. Okay, and if before the expiry of this term, 10 years in our case, if there is an unfortunate death of the SSE, then the insurance company will pay this sum assured to the nominee of the SSE. Okay, and if the SSE survives the entire term of 10 years, then nothing will happen. Then the insurance company will not pay, this 10 lakh to the SSE, and the premium that has been paid, it will not be returned. So this is called term life insurance policy, and basically it's in the nature of a pure life insurance policy. It's not in the nature of an investment policy. In all the examples we saw that the consideration is being received on maturity, and some bonus amount, etc., may also be received on maturity. So they have an investment component, and that is the reason they have not been made exempt fully in all the cases under 1010D. But term life insurance policy, it is basically exempt. So if you look at our TaxBook Plus, a policy which is not a key man insurance policy and excess premium policy falls under any other policy. In our case, the term life insurance policy. So it's basically exempt in all the cases. Okay. So what is the clarification? The clarification is that this limit of 5 lakh will not be applicable in the case of term life insurance policy, right? Because we are not supposed to tax it under 1010D. Right? Hence, any sum received under a term insurance policy shall continue to be exempt under 1010D, irrespective of the amount of premium payable every year in respect of such policy. Further, when we are counting the limit of 5 lakh, the aggregate of 5 lakh, okay, in case of multiple policies, as we saw, then we will not consider the premium paid for term life insurance policy for checking this limit. Right? Because so basically this term life insurance policy needs to be kept out of your calculations, and it will be exempt. Okay. So this is item number 1 regarding 1010D. Now we move to item number 2. Reserve Bank of India excluded from the definition of a specified person liable for TDS, TCS at higher rate. Okay. So this is section 206AB for TDS, and this is para 218A.1, and we know that for ROI non-filer cases there is a higher rate of TDS specified under section 206AB, okay, which is twice the regular rate or the rate of 5%. However, it was provided that section 206AB is not applicable to a non-resident who does not have permanent establishment in India. And also this point number 2 was inserted by Finance Act 2023. A person who is not required to furnish the return of income for the aforesaid assessment year and is notified in this behalf. So a person who is not required to furnish return of income obviously cannot be or should not be treated as a non-filer, and therefore 206AB should ideally not apply to such person. And such person then needs to be notified by the CBDT, and 206AB will not apply to such person. Okay. So now the Reserve Bank of India has been specified, has been notified. So which basically means that if in the question it is given that some payment has been made to RBI, and the RBI has not furnished its return of income, so can we apply section 206AB? Then you need to say no, because the RBI has been notified, and of course the RBI need not file its return of income, so there is no question of application of section 206AB. Okay, so this is the the change that has been made in terms of notification of RBI. Just like 206AB is for TDS, you know that 206CCA is for TCS. Similar provisions, and therefore in the case of RBI, 206CCA for TCS will also not apply. So this is what we need to note as far as the statutory updates to the tax book plus are concerned regarding income tax. So if you have any questions, doubt, clarifications, write to me in the comment box. Subscribe to my channel, like this video, and share this video with as many people as possible. I'll see you very soon in my next video. All the best to you. Goodbye.